Thank you, and good afternoon, everyone. And firstly, thank you to Kevin and the Marine Money team for inviting me to host this panel this afternoon to discuss the spectrum of ship finance options that are available at the moment. And we'll be focusing on, as Kevin mentioned, what's previously been referred to as alternative capital. We're going to discuss, together with our panel today, the variety of products that they both offer and work with, and we're also going to try and cover off some of the misconceptions that have existed in the past in respect of such capital sources. I've got a fantastic panel here today. So from my left, I've got Nicholas Petrakakos from Alantra, Halvor Svein from Maritime and Merchant Bank, and then we have Toufitri Akdime from EnTrust, Tobias from Fleetscape, and Nicolai Heidenreich from NRP Maritime Asset Management. So thank you all for joining us today. So I think to start with, and to provide a bit of a flavor of the spectrum of finance that is available in the shipping sector, aside from what is often referred to as traditional bank debt and putting aside PRC leasing, could I please just ask each of the financiers on our panel today just to give some key points regarding your respective offerings in terms of the types of finance products you utilize, deal size, leverage, target asset types, and also a bit of a feel for the size of your portfolios as well. So, Nicolai, did you want to start from NRP's perspective?
I manage a credit fund out of Luxembourg. We have currently about $120 million under commitments. We have started slowly building a lending portfolio consisting of first lien, single asset type transactions. Our sweet spot size-wise is 5 to 10 million. We can also go below 5. On the current fund size, we don't really go above 10. So we think small is okay. We offer fixed price coupons only, so no sort of interest rate exposure on that. Leverage 50 to 60. We can go as high as 65. Our target assets are mostly containers and dry bulk, and we have lent money to ships that are close to 20 years old, providing 5-year finance. So we are not that concerned about age. So I think that's sort of the gist of what we do.
Super, thank you. And from a bank's perspective, although a relatively new bank, Halvor, would you like to just follow on from that from M&M's perspective?
Absolutely, thank you very much for that. And we are into our 7th operational year. We started our operation on 1st of January 2017. Is a traditional bank regulated by the Ministry of Finance in Norway. That means that our funding is based on equity and deposits from the retail sector in Norway. We are extending first priority mortgage loans to traditional ship owners, project-oriented first and foremost. 50% of our customers are based in Norway. The rest is spread on the well-known shipping hubs in Hamburg, Singapore, Athens, some business in the United States and so on, Asia, Hong Kong and Singapore. We focus on the conventional tonnage. We are not doing any very much sophisticated stuff, so it's basically handy-size, Supermax, Panamax bulk carriers, the tank spectre, both the products and dirty, and the container super cycle we also participated in. Now it's a repricing going on there, so we'll see how the road leads us. We are 26 people in an office in Oslo, but have feet on the ground in Hamburg, in Singapore, and in Athens. So that is in sum what we are doing. The sweet spot is say between 10 and 15 million dollars. We can go up to 25 and even a little bit higher as a maximum ticket. We are cooperating with other banks from time to time in club deal structures, and leverage is say everything between some 45 to 60% is very much dependent on the character of the project. So yes.
Okay, perfect. Thank you. And Tobias, will you follow on from that from the Fleetscape perspective?
Sure. Fleetscape was also started in 2017. It was set up as a alternative lender to the maritime industry. We cover the entire maritime space. Anything that floats, we will look at it, either in the form of loans, leases, or pref shares. We're effectively a high leverage capital source for the maritime industry. Sponsorship by Oaktree and based out of London. To date, we've financed 67 vessels, 1.6 billion of gross financing. Generally, the leverage really depends a bit on where we are in the market cycle. Everybody here will say that we're counter-cyclical. None of us truly are, but we all try really hard. So in the low market, we will be quite high leverage. In the high market, we are actually quite low on the leverage space. So we've gone, we've been to 80–85% financing in the low market for certain market segments. We generally prefer to deploy at least $20 million per deal. And otherwise, we have fairly wide flexibility on exactly how we can put the structures together.
Great, thank you. And Tufi, the EnTrust perspective, please.
Yes, so we are maritime investor. We have now invested almost 3 billion on the maritime space. We have quite a large product offer. We do equity to senior debt and everything in between, actually. In terms of asset type, it's also quite diversified. With obviously at the start, mainly tanker, bulker, and container, but we are actually expanding that diversification on the asset type. On the ticket size, it's also quite a wide spectrum. We can do a 10 million to 300 million. We are 15 people, and we have also a global reach across the globe. And now the EnTrust business is almost 7 years now, track record. And in terms of also size of the ship owner, we like the small one, the multi-generational entities, but also we can also have some partnership with the bigger entity. So it's quite optionality, maritime investor with the various options that can fit with different and specific situation.
Perfect, thank you. And Nicholas, obviously with Alantra not being a financier, but being on the advisory side, I mean, we've heard already from our 4 panelists that there's such a wide spectrum just amongst these 4 institutions. But can you just give us some flavors to some of the other types of products that you're working with when you're working with customers to fit transactions to particular financiers?
Yeah, of course. Thank you very much, Ian. So Alantra is a global investment bank, and we have offices in 25 countries around the world, including main shipping hubs like Frankfurt in Germany, London, in Dubai recently, and of course in the US, which gives us access to a very broad spectrum of capital providers, being it banks, leasing houses, or private credit funds, etc. We have been successful in working with most of the panelists here, and they are core relationships for us. But there are also other types of capital, as you mentioned, that are very important in shipping in general, in different type of projects, of course, in different kinds of LTVs and interest pricing. For instance, Chinese leasing has become much more prominent, even after all the events we saw last year with alleged corruption in that system. We see them coming back very actively on the new building space. Of course, there are other funds with different products as the ones presented here that are also investing very actively across the capital structure and in different sectors. And for us as a team at Alantra, we have managed to also source capital from the Middle East, which was capital primarily targeted towards Middle East companies. Initially, we have managed to get some of that capital out of the region and invested with Greek and European clients. So in general, I think the alternative financing spectrum, which is, we call it non-traditional, not alternative really, has grown a lot since 2017. And it's, there is something for everyone. As an advisor, we managed to bring that something to the appropriate project, the appropriate capital matched to the appropriate project, the appropriate client.
And I think one of the observations I had from talking to each of you while we were preparing for this today is that it's very infrequent that you're actually competing for the same transaction just because of the very different types of sources and types of structures you're utilizing and the conditions that you impose on your customers. And obviously, Nicholas, that's music to your ears because it means that you've got a fantastic role there of finding capital for these more challenging projects as well. So, so we've heard already about there's such a broad range of capital out there, but I think we've got to get on to some of the misconceptions about this type of capital as well, because look, we've all heard it. A number of people in this room would have said it as well, and I think a lot of these misconceptions go back to how private equity entered the shipping space after the financial crisis. And even during the last few years, I hear the same, two or three things being mentioned about these types of capital sources when I'm talking to clients about how they might finance their projects. I'm being told, why would I want to use this type of capital, Ian? It's just too expensive. Really, I hear a lot about it, but how active are they? And then the third one is, are these institutions in it for the long term? And I think it's important that we focus on some of these because they are outdated, but maybe we could go through a few of those. And Tobias, do you want to pick up on a few of the points?
Sure. There are two big things that have changed the way the market operates. One is rising interest rates. Our investors' target return hasn't changed, but the floating interest rate has gone up. And what that means on a relative basis, we become much more competitive versus traditional bank financing or traditional financing overall. That's a very important one. On a marginal basis, we're not that far from the banks, even though we give a higher leverage. The other thing that's happening is that size really matters in this world. And as our balance sheet has grown bigger, banks are willing to lend to us at a much cheaper cost, which we then pass on to our clients. As an example, when we first started, the banks were looking at everything we did as a project, one-off project, and our borrowing cost was quite high from a senior bank's perspective. Now we're generally viewed as a company or balance sheet, and we can borrow money really quite competitively, and that cost benefit is then passed on to the clients. And the other element of growing bigger in size is you can be much more flexible on what kind of products you offer and how you structure deals than you could when you were first starting out. So it's really changed dramatically from when we started in 2017.
Great, thank you. And Nicolai, did you want to add on to that from your perspective as well?
Yeah, I think what you've seen also when you talk about, are these guys here to stay? I think the people in this panel, I think, all four of us have been in the maritime finance industry for most of our professional careers. So I think that is quite different than sort of someone just coming into the industry, seeing that there's an option to go in here, make some money, quick bucks, and then move out. I think that has changed. I think this panel is an example of that, which also means that the knowledge is there, and you're lending out 5 to 7 year tenors. I mean, it's by definition we are here to stay because you like to get your money back at the end. So I think that has also changed. So it's much more sort of professionalized shipping-wise, the type of call it non-bank lending has become much more, which is also why it's not called alternative anymore, because it is actually shipping people lending out shipping money.
And I guess with being shipping people, when you inevitably have a problem, an issue, you're then able to work with your clients to find solutions to those problems as well. Is that fair to say as well?
Well, I think it at least increases the chance that there will be a solution found. But of course, we manage equity funds, so sometimes it's actually better to borrow money from people that don't understand the industry, because then it gives you a bit, from an equity point of view, it gives you a bit more leeway to sort of maneuver as things start to get tricky. So it's sort of, so I think yes and no. I'm not sure it is a benefit for the borrowers, but it also means that the equity can't fool the lender in any way. So I think what we have done, one thing that we do, is that we have said that the minimum value clause is based on vessel value. And then you can agree or disagree if vessel value is sort of the right, but we have said that is so, and that's like LIBOR. I mean, it's a print screen, because what we have seen is that, my broker, your broker, you come back and you spend 3 months arguing what the value of the ship is, and by then it's down another 20%. So I think, we just decided to say, okay, this is the value, and if you're in breach, it needs to be fixed. And if it's not fixed, then, we have to talk about the alternatives. Trying to sort of simplify, which of course has a backside to it, but I think that it makes it more balanced, that discussion between debt and equity, if there is a problem.
Super, thank you. And Tufi, from the EnTrust side?
Yeah, I think what's really important is time has changed. I mean, that the conception you have mentioned, if there is still people who has that conception, they really need to change their mind, because the dynamism of people like us is really there. And I mean, we have now 7-year history, and I can tell you we are still here, and I'm sure we will grow even more. I think the expertise is a very important point. All of us have maritime expertise, and it's quite diverse. Actually, we do have that shipping experience, but from different angle. And I'm a big believer on the having a diversity of approach in this complex and turbulent time. So yeah, I think the experience is there, and there is a need of people like us to support this industry. And actually, we have also quite a regular ship owner who come back, and we have repeated transaction, be it on the debt side, but also on our partner on the equity side. So I really don't see it at all as just just a one-shot opportunity to go there. I think it's here to stay, and there is I think the share will be. I will not be surprised to see that part of financing from our structure to grow, because there is basically a need for that.
Perfect. Well, I'm glad it's here to stay, because it keeps me gainfully employed, so it's always helpful. Okay, well, let's move on a little bit, and have a question for you, if I may, because we've heard how Nicolai, Tobias, Tufi, how the products that they've worked with, how they've developed over the years, how successful that they've been. From M&M Bank's perspective, are you going to be looking to try and compete with them, or are you actually trying to develop your own kind of niche in the market as well, maybe sitting somewhere between what has been referred to as traditional bank debt and what has been referred to as alternative capital?
It's a good question, of course, and I wouldn't be honest if I didn't comment that from time to time we feel this competition is very annoying, of course, and we have tried to follow our own path, of course, and develop this as a bank, specialized. We have a single product, and that's the first priority mortgage, and we are definitely not a digital bank. We are very much analog. We are putting on our best suits and ties and dealing with the clients over the table, trying to find good solutions when the tides are turning a little bit. So in that context, we try to follow our own route, but of course we are also gazing out of the window and sees what's happening. And I must take the opportunity to say something about that, you know, because it's obviously so that this is a competitive market, and it's the competition is expressed by the margins, the loan margins, which is actually we do not we shouldn't forget that this is the pricing of the risk. And I think honestly that 250 basis points is not the prudent pricing of the implicit risks in shipping. Quite simply, I know that of course it's a matter of cost of capital and so on, but there are no magical formulas out there as well, you know, for the cost of capital when you turn this into a RAROC estimates within the banks. Okay, I can pray for my sick mother, but this is how we regard it. So we will trying to hold on to what we are doing. We will definitely have our left eye on what's going on, of course. But at the same time, I reflect a little bit, as you said, Nicholas, is that there is a big universe now out there for ship financing, and it's actually a space for everyone, as long as you're doing your job prudently. So there should actually be opportunities for everyone that are offering something that is of interest for the industry, of course.
Must be good for you to hear that the competition finds you annoying. It means you're doing something right as well, doesn't it? So then, Nicholas, given what we've heard from the other panel members so far, you obviously come across a number of kind of challenging projects that are quite difficult to find financing for. Let's face it, that's the reality of the business that we are sometimes dealing with. Could you maybe just talk through an example or a case study where you've taken a very difficult project which has not been easy to find a home for from a financing perspective? How you've worked with the company to maybe modify the product, and how you've worked with the prospective financier to modify their offering. If you can run through that, and then I'll obviously open it up to the rest of the panel to give their views on how they might have approached it as well.
Of course. So when we usually take a project on to find finance for it, it comes from a sort of challenging aspect, right? We don't have the top 5 Greek names calling us. It's more mid-size owners with no traditional bank relationships, or somebody that wants to buy their first ship. So it's challenging from a structural perspective. But these are not the most challenging, of course. Usually these sort of deals can be placed quite easily within 2 months, maybe some with panelists here, some with people that are not present. The most challenging deals that we have done in the past are those that are coming out of restructuring of a company or reorganization of its debt, etc. These are very delicate situations in the sense that you're coming from a scorched earth, if you will, situation that needs to find a new home. So you have to do a lot of damage repair in the reputation of the company, maybe the assets, and find investors that not only lend to the market, but have a view about how this company will survive. The good thing with having that universe available to us is that you usually will find such a home. Of course, it takes much more time to explain the situation, how we came about that situation, what's different going forward, and to find the right capital to support a business plan, not just an existing operation, but really a hope, a dream. But that's the case really for all the projects we take on. Our first, let's say, order of business with a client is to institutionalize a client, to make them bankable, with assisting in understanding, first of all, their business, help them with their strategy, which of course includes the financing. And then we run a process to find the most competitive financing for them, but that's not always the margin cost. So there are cases in our history that we have placed a loan with a higher cost lender for a client, but because there are other aspects to it. There were no covenants, for instance, or higher LTV, or less expensive to exit that structure. So back to your previous question, a lot of people say it's expensive, especially the alternative financing, but it's much more flexible. How do you price that flexibility? Especially when the market is bad. When the market is good, everyone is happy and fine, but when the market turns around, you need people that not only have a product to lend, but also to be able to get a view in how the market will perform later and whether they will be with you in that process.
It's effectively opportunity financing, or I think, Toufitri, you and I have referred to it as enabling financing maybe. It's just, there is a possibility of a transaction there and then growing with the customer. The customer may not stay with you as a financier, but you've at least allowed the dream to start. Okay, well, anyone else want to add on to that?
I think just to add what you just say about how do you price that flexibility, but I will also add to that also how you price the speed and the execution and the decision making. That's really massive. We can also face a situation where we have a ship owner who wants to make a very specific strategic move and need to go fast for it, and we can be there, and we can be there maybe just for this period of time. By the time he settles his dream, as you say, and then he has another option available, that is also fine. But that having people who the decision maker to go ahead in this kind of organization really give a big leverage on the execution and the certainty of the financing is also something that we see is many people are looking at it.
I think more often than not, we are not necessarily looking at one specific thing. We are presented with a financing need, and inevitably you'll start a discussion for a loan and end up doing a lease, or you'll start up a discussion for a lease, you end up doing a loan. We were in discussion last year on somebody wanted a preference share issue behind an existing debt facility, and we ended up doing a senior loan to take out the entire debt structure. So I think we all sort of thrive on identifying the need or the opportunity and then tailoring it as it needs to be provided.
We've also gone even further with you of you're doing a loan and converting it into a bond in the last minute as well. So, and that's where the flexibility comes from. So, Kevin, we can open to the floor for some questions. I have more questions if the audience is quiet. But.
So my question is, I mean, how do you guys, what's your view on green finance, and how do you, factoring this into your future offering to the industry?
Green finance.
Yeah, it's again a very good question. We are receiving a few inquiries these days, for different type of vessels within, I would say, generally within the green shift. But so far it's hard for us to use our traditional credit models for these projects. So it needs a bit of fine-tuning actually in order to get into the grip of things, because the residual values is of course very difficult to consider. And what we have been looking into is with contracts that are of fairly short duration, about 2 years duration. There's been to offshore windmill parks and so on. So, but we definitely will think of creating a green corner, so to say, of the bank. But then we have to employ some new persons there. So definitely we need to dive into this now.
And I think in this area of financing as well, what you do need to bear in mind is what the investors actually want, the investors into the platform, because that is the thing that we are seeing changing. I mean, we've got representatives in the audience here. I think I've seen Andre's here from Prow Capital, and you've got the likes of Eurozeo. Their investors require certain green credentials to be fulfilled. And I think one of the bigger points going forward is when you're going out and doing a fundraise, is what the investors actually want. Are they dictating green terms? And that may change from different type of institutional investor and also geographical location.
I also think green financing means something different for each individual person. We probably have no one here with exactly the same definition of what green is. So for us, we're more focused on how do our clients improve their carbon footprint, and if they do, we monitor that and we give a price break on the improvement and the performance of the assets that we finance. So there will be a pricing trigger in the deals that we do that award our clients for a greener profile.
Thank you. Well, I know this is a topic which I personally can talk about all day. We spent most of last night talking about it as well, but we've come to the end of our half an hour. I think we're all staying behind for most of this afternoon and for the drinks this evening, so if anyone's got any further questions afterwards, please do get in touch. But Kevin, back to you.